Mode.
Good morning, everybody. It is Thursday, May 24th, just after 10 o'clock on the west coast of the United States. Dr. K is in Cannes, France, continuing to live his extremely deprived and difficult life. He's having a little trouble with the internet today, but he seems to be okay right now, right, Dr. K? You sounding good over there?
So far, so good. We'll see how this works for the next hour.
Okay. Anyways, what's happening? Market direction models on a sell signal, still on the sell signal. The last couple of days, you're coming down to the 200-day. Last week, it looked like you were on the Nasdaq. You were definitely going to run into it, but you stopped, and you got a nice rise on Monday, and so you pull back a little bit on lighter volume, and then you pick up volume yesterday, and you get some support. You're kind of in this little chop zone right now. We'll see how it resolves. You may end up rolling over, or you could also, since you are 1, 2, 3, this would be the fourth day off the bottom here because your lows are on Friday. So first rally day, second, third, fourth. You could, crazily enough, get a follow-through day in the next few days. But the other side of that is there isn't much on the buy side here that looks very good. You're definitely using tricks to come in either on shakeout plus N number of points to buy into, or even tricky little pocket pivots. But there's very few constructive buy points showing up, and I think if you're trying to take the long side anywhere around here on a bounce, you're just day trading it. And in fact, I did single day trade Apple roughly off the lows coming up through the 555 area, but I'll talk about that in a bit. But that's just a day trade or short-term trade, and I'm just messing around trying to feel out this market. Mostly what's been profitable has been the short side, and we have been able to make some progress, both on the inverse side with the ETFs using the market direction model, and you can see, we're looking potentially for a rollover here, but anything could happen. So you're down a ways. It gets a little bit obvious on the downside, so you might go back and forth for a little bit here, a couple days, or you might break down sharply from here. Who knows? But you're kind of in no man's land right now as you bounce off at this point, just above the 200-day moving average, probably just to fool the crowd and to get everybody thinking that the market's heading down to the 200-day moving average, and stops right here and turns around just shy of the line. So it's really where you are. You're in the midst of a market correction. I tend to think, and Dr. K, feel free to chime in here, I tend to think that if you're in cash, you're okay, because one of the things I don't like about this market is the fact that it's highly news-oriented. And you could just as easily be gapping up as you could be gapping down, and I think that's something you have to watch out for. If I'm going to play this market on the short side, I want to be very nimble, and I want to be able to trade in and out pretty quickly. And that said, there have been some short sale target stocks that even today are working, and of course you can see up on my screen we have LinkedIn over here. Let me just get these out of the way. Which it looks to me like in this big IPO type pod formation, it's a big bowl, kind of an ugly pattern. One thing I noticed is there was a ETF, the SOCL ETF, and this thing came out sometime around I guess early December, late November last year. And of course, when these ETFs come out, this is similar to that SKYY cloud computing ETF. When these things come out, they have to buy these stocks. And there's not a lot, I think, in the social networking area. So these guys got to buy, LinkedIn and probably Zynga. And it's interesting here that LinkedIn starts its move off the lows right at about the time that this ETF occurs. I'm wondering, was all this buying big institutional buying, or was it partially driven by an ETF having to take positions in a stock like LinkedIn as a big social networking company? And so you wonder, was this for real? And you remember last year the clouds had this big move when the Sky ETF came out, and then when that fully loaded up all its positions in cloud computing stocks, they all rolled over. So maybe that's what's going on with LinkedIn right now. You can see the break below. You consider this a failed breakout here, and now you broke below the 50 days, so you're using rallies up into the 50-day, maybe a little further to short into. So looking at a daily chart, you can see the last couple of days it comes up, and here it goes a little bit past, and they can do that. I saw it potentially getting up as high as 107. If the market rallied, but it all depends on what the market's going to do in terms of how far up it can rally. But if it does roll over from here, you're trading above average volume today. You're already hitting the line just after midday in terms of the 50-day moving average of volume right here. And I think that it's looking like it wants to head for the 200-day moving average. If that were the case, you'd be undercutting these lows and you'd be hitting the 200-day moving average. That would be my initial downside price target if this thing carries through. I could also undercut this low and then attempt a little flip back to the upside. And that might be one last chance to jump on it. But last couple of days we talked about it as it was coming up on Monday and then again yesterday. And it looks to be starting to roll over. So this might work, but that would be my target there. The other one I'm shorting here is Salesforce.com. Similar situation, almost identical, in terms of being a big pod, ugly pod formation. And here's your breakout attempt, and it fails. You bust the 50-day, 10-week moving average here. You rally back up into the line here. You get the gap up on earnings, and you stall out right at the 50-day. I kind of looked at this two ways. The first one would be that it's coming up to the black 65-day exponential. Try shorting it there. You get stopped out real quick, and it continues up towards the 50-day, and I think got to 152 and change the other day. Let's see, is that right? No, 151.91 and change on Tuesday. And so you can come after it again there. And it's starting to come loose a little bit, but not a lot of volume today. What's really getting cratered in this group is F5, which is broken down. But again, you can see this idea. This is a big ugly pod in F5. And then you have VMware, which is also a big ugly, not necessarily a punch bowl of death, but just kind of an ugly pattern. And it's failing and trying to break out, and it's failing. And now it's really blowing down to the downside. So I'd be looking for CRM potentially to follow these other clouds, because I remember that the F5, VMware, and Salesforce were the, you might call them the power trio with the big cloud computing stocks initially, and they were later joined by others like Riverbed and Acme Packet and so on down the line, Rax, all different cloud-related stocks. I think the group is probably going to get dragged down, so I think that CRM becomes a good candidate here, and it's in position to short. So other ones that I've been looking at, VRX come down to the 200-day on this break, but here's a late-stage failure. Consolidated or CF Industries fertilizer comes right up into the 170 area. That's actually shortable on that rally, I think. This is shortable here, but you broke down, and now you're rallying back up. It may take some time to work itself out sideways here, but that's another one that's broken down. I'm just putting up these stocks that I've noticed have broken down over the last couple of weeks. Here's another one that's brutal. Google sitting here with some heavy volume the other day last week when it broke down and holding above the 200-day and kind of locked in this zone between, say, the 65-day, 50-day zone here and the 200-day moving average here. I think if it busted the 200-day moving average on heavy volume, it would probably be shortable. Or rally up into the 620 area, somewhere around the 65-day exponential and the 200 or the 50-day simple rather up here, around the 620 area more or less would be a nice place to short the stock. When I look at Google, it's really been an underperformer for a long time. You're starting to see big red volume spikes on the weekly chart and just kind of an ugly pod-like sort of pattern with a lot of distribution, and it's possible Google may begin to break down, so I want to keep an eye on, I think. Chipotle Mexican Grill, to me this one's just trying to form a base right now. That's all it looks like, although this pattern looks pretty ugly, and you're kind of locked in this downtrend channel. You got to wonder if you're at the top, is it shortable with the idea of playing it down to the lower end of the trend channel? That's a tactical short, because it's not necessarily clear to me that CMG is completely broken down, but you'll notice it's running into resistance in this zone where the 65-day exponential here and the 50-day simple moving average here is starting to converge again. So a little bit of resistance in this area, and it's interesting that it is in this very well-defined trend channel right here. Let's see. I love drawing lines on charts. Let's see. There we go. Oop. I don't know. Maybe that's it roughly. So, maybe you could short up here using this as a stop with the idea that it's going to break down to the lows of this trend channel. But you can see these leaders, former leaders, are all starting to break down. Everybody knows about Netflix. We talked about that. Still finding support here along this little area of consolidation. Still looking for it to test 60. It's now below the 10-day moving average, so if you're short it, you might consider that or the 20-day moving average as your trailing stop on the upside. RAX is another one. I think it's heading for the 200-day moving average. If you wanted to short it here, you'd use the 52 area right here, near-term resistance as your quick stop, and I think that's heading for the 200-day moving average, one way or another. Anyways, let's see what else. I think we talked about that last week. F5 getting creamed, and VMware continuing to get creamed. A couple of stocks that looked interesting on the long side, but we're not going to play anything on the long side. Excuse me. As long as the market remains in this state. If we had a follow through that, keep an eye on this one. Hey, Dr. K, you there?
Yeah.
Is this day here 4 days ago? Is that a pocket pivot?
That would just barely, looks to me like it just barely would have the volume for it.
Yeah, it just barely did.
Looks like it shook out, it tested, and now it's coming back up through the moving averages. It's an interesting stock. I like the gap up. I like the formation if it's forming an island here. So it's one to keep an eye on if the market conditions should improve.
I thought I'd comment on Facebook. Kind of a joke, I think, but you have to think about this. If you go back and you look at some of the big IPOs of some of the big internet stocks, Amazon, Google, Apple, eBay, or technology stocks in history, you look at Amazon when it came public, 3 million shares were offered. When Google came public, 19.6 million shares were offered. When Apple came public, I think in 1980 at $22 a share, they offered around, I think it was 60 million shares. And you look at eBay in 1998, and they offered 3.5 million shares. So here you have Facebook basically saturating the market with 420-something shares. I think that's what it was. Is that right, Dr. K?
Say that again. 420 what?
How many shares did Facebook come out with?
Oh, it's overhyped. It's on the basis that it should be a $100 million company from the starting gate, and of course that's disappointed investors because instead of, I think it was about, it's what it started out around 84 million with the float being 492 million shares.
Right.
And it's broken issue price of 38. So right now it has a market cap of I think about 70 billion.
And the float right now appears to be, let's see.
Well, it's 492.
492 million shares.
492 million.
That's a lot of shares to just dump in the market right off the bat. So they don't even do what other highly entrepreneurial and high growth companies have done in the past, which is they don't issue a lot of shares to the public, and they're banking on making a lot of money themselves internally. I think by owning insiders owning the stock once it comes public. And I think Facebook, everybody's dumping the stock. There's a huge supply out there, so it becomes this massive, lumbering big cap stock right out of the gate. And I think that's going to, at the very least, it's going to take a while for this to work through and build a constructive base. Now, you could say, if we were looking at, say, eBay, let's take a look at eBay back in 1998 when it came public. This is what eBay looked like on a daily chart when it came public, and it came down. It declined 50%, so it got smacked around. You were in a bad market in October, though, brutal bear market where we came down over 32% in 3 months. So it got hit with the market, and when eBay turned around, it took off and never looked back. But I think there's a pretty big difference between the way this is breaking down and the way Facebook is breaking down initially. Let me try and make it look more like eBay. It's hard to do because it's just really steep. And of course now everybody wants to sue, but I think people should have looked past their own greed and taken a closer look at the numbers. You have a company with minus 9% earnings growth in the most recent quarter, 17% before that. So in terms of actual numbers, and this is a company that supposedly dominates its space and has revenue streams, but it doesn't seem to be able to produce any huge earnings growth despite that. And this doesn't even meet the parameters for our style of investing. So definitely not anything you're going to touch, not for a long time. Maybe they're able to execute going forward, but I would point out that they're going to be doing battle with Google going forward, and no company on the internet is this masterful, really, at monetizing their various services than Google and probably Apple as well. So I think Facebook has their work cut out for them. So not a buy right now, but something definitely to keep an eye on to see what happens. And remember, situations are dynamic. So you watch the price volume action. We can sit here and intellectualize about it all we want. I do think in the near term you have the saturation of shareholder demand, because remember, if the retail investor can get into one of these IPOs that's so hot, something is not right, because usually a hot IPO, the only ones getting it are institutional investors. And I thought it was funny that the media trumped the fact that the retail investor was able to participate in the Facebook IPO, and my first reaction is, what's wrong with this picture? So, anyways,
That's a
that's
huge
kind of what we're
red
thinking about
flag.
the market.
These things are always generally oversubscribed, and that the fact that retailers got in as easily as they did is really a bad sign in terms of whatever the structuring of the deal was. It's max almost of it makes me a little suspicious. And the question, though, I mean, I'm not throwing Facebook to the dogs here yet, because the big question is, will they be able to monetize in novel, unique ways? They do control 900 million people, or at least they have 900 million eyeballs, and that's a huge sword of power that they wield. So if they have some great, clever ways to monetize, and there are a couple ways that they've discussed that could result in big revenue streams, we'll see it in the stock price. We'll see it show up in price volume action.
Yeah, and that's kind of where we're leaving that one for now. Meanwhile, I think we'll go through some questions, so kind of know where we stand, and I got a couple of shorts that we're working on. We did put out, the LinkedIn, which is working today. Let's see, where did my daily chart go? Here it is. Yeah. Starting to break down here. Volume is up, so it looks like it's possibly heading for the 200-day. And then CRM getting dragged down today, at least, with VMware and F5, but we'll see if this carries through. So it could just consolidate in here, but keep an eye on that one. Someone's asking about CHK. Not really anything. I think it's stuck in a downtrend, so I don't know what to say about it. I'm not going to short it down here. It's way down. Let's see. Somebody asking about GM. I don't know. Why are you asking about stocks I never even look at? I don't know. Why don't you ask me about Procter & Gamble? I might have a better answer. I mean, to me, this just looks like, it stinks, and Government Motors is what it is. A company that makes lousy cars, and it really is not the original General Motors. If you make things like the Volt, and I think that says it all. But no other comments than that. GDX has been underperforming gold for several months. Yesterday, GDX changed it. Really, any hope for GDX here? I don't know. We're not really looking at that. Are you looking at the GDX here, Dr. K?
Well, the miners and gold have a rough correlation, but keep in mind that gold's going through a big basing pattern, and so is GDX. And when these things base, they tend to be volatile and sloppy. That means that there's not going to be a correlation that you might expect, say, if one were in an uptrend.
Yeah, and the situation with gold is that it's still in this giant consolidation. It looks like it gets viable under 1,500 or somewhere thereabouts. But I do think in the near term, the situation in Europe necessitates that institutions are going to be raising liquidity, and that means selling assets. And you have to remember that most of the gold that's traded out there is paper. I was having lunch with a friend who's trying to buy $1 million worth of gold bullion, and they're really, they weren't not really able to fill his order, despite the fact that supposedly gold is coming down in price. But that's paper gold. And so I think you have to weather all of that if you're a physical gold holder, but I think there will be a time and a place to be buying back gold aggressively. Right now, that really isn't the case. If the market could go up or down, gap up or gap down, should the MDM be in a cash signal? Well, the thing with that is you get a signal, and then you decide how to use it, understanding some of the contextual factors in the market. So if we think, for example, you're in a high-risk situation, if I'm going to be trying to short this market or go long, say the TZA, for example, right here, I want to be in a position to move very quickly and to be trading these if necessary to get the heck out of the way in a hurry. Other accounts that have a lower risk profile, I might be just happy to be in cash right now. So no, it doesn't mean that the MDM has to be in a cash signal per se, but you can see already that if you have several bad signals in a row, then you're going to have to tone it down one way or another, because you keep getting hit 3%, 4% every time. Before you know it, you're down 40%. And so you have to start thinking in terms of risk management in the context of a market that is highly news-oriented and also subject to influxes of QE. I mean, what if the Greek situation prompts the Fed to come in with some formal announcement of QE3? And you'll notice some of the Fed heads are starting to talk about that being necessary. And I think that you have to watch out for that. So I think it's a high-risk, dangerous market. Dr. Kenny, comments on that?
Yeah, I mean, these gap up, gap down environments characterized much of 2011. It adds risk naturally, and there are periods where the model will tend to stay in cash. Like after the May 2010 flash crash, there was so many cross currents in terms of the price volume action. The model actually stayed in cash longer than it normally would, which was a good thing. Otherwise, it would have probably had a number of false signals after its big score in May of 2010. Now, right now, it doesn't see a need to be in cash. It does still see an edge to being on a sell signal, but it is, of course, waiting for a follow-through day accompanied by constructive price volume action on the part of leaders. It is waiting for that moment, but it's also, if the market were to get volatile and potentially directionless, the model is more than likely to take its profits here and move to cash.
Somebody's asking about, they shorted LinkedIn in here, and then it rallies up above the 50 or you get stopped out. I shorted LinkedIn here as well, but I was using the 65-day exponential as my initial stop, so I got stopped out very quickly. And then it runs up here, and I come back after it again up here. So how do you solve that? You have to be willing to be stopped out, and then if it starts to fail again, I start stalling out in here. I come back after it again and short it again. Now I'm actually making money net with the stock starting to break down. And again, I thought it was shortable this morning pre-open. They had the thing trading between 103 and 104, and I thought that's right up in here, and that's a gift. You could have shorted this thing pre-open, and of course, once it gaps down on the opening, usually that's a sign off the 50-day to come after it, at least with a small position or a partial position. And now we're working this, hoping to see it to the 200-day. But there's no magic way to deal with stocks, especially stocks that are as volatile, say, as LinkedIn. You can see that in the range. It's very choppy. So you know that if you do short it, it's not going to necessarily be at an inflection point. It's going to immediately obey you and head straight down. You're probably going to get pushed around a little bit, and you're going to have to dance with the stock for a little bit. And if you're not willing to do that, then you shouldn't be shorting to begin with. And also, I would mention this has been an issue for some people as well. Wash sales can be an issue in your account depending on what kind of accounting you use. I've heard people say use mark-to-market. I actually account for it as Schedule C income on my trade, so that's also a mark-to-market situation, and I let my accountants deal with it. But if you are subject to wash sales, then I think that can be a problem trying to come in and out. So I think that does limit you in terms of your ability to short stocks per se. You could take a couple of shots and be willing to take a small loss, but if it doesn't work out, you can't be doing this all day long, because then you'll just have a bunch of losses that you can't take and some gain that you're going to be taxed on. So that's something to think about. But in any case, you do have to be flexible when you're running these shorts, and if you get stopped out, I look at this here. This looks to me like it's undercutting this level, but it could continue to break hard to the 200-day. But I know that I've got the 65-day exponential right here, so I just set the stop right there, and boom, I'm gone when it comes up, and then I can hit it back up in here as it's pushing up into the 10-day and the 20-day and this whole area up around 105. And so, it gives it a few percent, 3% past the 50-day moving average, which comes into play, or came into play rather, on Tuesday and yesterday as well. So, that's really how you're working it. Now what you're trying to do is get this big move to the downside. But you can see, let's look at an example of one that broke. I mean, CF, this is a rare situation where it breaks down and it just sits there, and one day and then boom, it goes. But you can see F5, for example. Here's the breakdown. It breaks down through the 50-day and kind of hangs out for a couple of days, breaks down a little more, hangs out, and now it's really breaking down. So they can take a little bit of time to set up, and you kind of have to account for that. Watson Pharmaceuticals. Um, I'm not. I mean, you have a viable gap up here, but it fails very quickly. So I'm not interested in any long ideas right now. SSYS. Everybody loves this one. It's trying to break out of this flag. So in this environment, would I want to be buying this necessarily right here? You'd have to have a follow-through day, I think. Dr. Any comments here?
Well, there's a gap up here, but it's in a bad environment, and I wouldn't trust this kind of stock. It's not overwhelmingly so strong that it could potentially buck a trend. I don't see enough evidence. If you really want to play this one on the breakout, you could go in with a half position or less.
Yeah. Asking about Splunk. Well, here's another one. You're in a base, basically, so you come straight up off the lows. I wouldn't be buying this. And it's not even enough volume to be a pocket pivot, so definitely not one you want to buy here. But it is possible that you're now in the weekly chart is continuing to build a base, but I'm trying to make this look as nice as I can. But you're down 1, 2, 3, 4 weeks, so you're just in a base now. You're in a 5-week base, and that's pretty much it. So wouldn't be buying it here. Whose dog is that? I just heard a dog.
Cats.
What's that? Oh, okay. So that's what you're saying in Clan there. I love it. So the dog actually, I think, giving some very appropriate market commentary right now. So the dog knows what he speaks of. Let's see. No signals on the VIX. Yeah, what's up with your model there on the VIX there, Dr. K?
Well, it's staying in cash because it's not sensing an edge. The market's come down very hard, and there's a lot of potential volatility, and it needs to see an edge before it issues a signal. So right now, it's best to remain in cash. And the model tends to issue a lot of signals when things are good because it's a shorter-term model. But right now, it doesn't sense the edge, so it's going to stay comfortably in cash.
Yeah, it's pretty sloppy, and that's one of the reasons for those of you who are the VMAPs, the Managed Account Program. And there's always a couple of questions there. We are going to be having a webinar on that on Tuesday. But the bottom line is we don't really see any reason to have to try and play this right here, right now. So we think we can just hang out and wait for a better signal or a period where the market gets through this news cloud, and I think it's going to create a lot of volatility. So, that's kind of where we're at overall with the models. It doesn't mean, we're not even playing a full position in the TZA in high-risk accounts. We're playing more like 25, 30, 35%, whereas we would want to normally go in 100% long the TZA, but can't really do it. It feels like it's a little bit slushy and dangerous, and so I think you have to keep risk measured here. And being out, it's fine to be out. I always love, though, people are excellent hindsight investors. Why didn't you do this? Why didn't you do that? Why didn't you do this? It's like, well, because we didn't have the benefit of hindsight primarily. In any case, GNC Holdings trying to hold the breakout level here. Getting sloppy, though. Getting sloppy. And that's not a double bottom shakeout. I don't see it as a shakeout. I don't think you want to be looking at stocks on the long side. Is there anything to glean from the TVIX, UVXY remaining neutral? Yeah, I think Dr. K just said that, right? I mean, for my money, I say buy the UVXY here. Use the low of the day at 1871 as your stop. Okay, that's it. And then see if it, but that's a couple of bucks lower. But I think this thing could go higher if the market rolls over, obviously, and it's sort of pulling back. But it's tough. It's a tough one to play. I played it, and I've been making money on it lately, but boy, it's crazy. And I think I get mostly lucky just sitting through all the wild gyrations all day long. Some of the stocks are hitting all-time highs like EXPE, SSTRIP. How would you trade those? I wouldn't buy them. If we had a follow-through day, that might be where I'd want to go. Tesla shortable doesn't really show up on my radar screens, maybe because it never had a big move, I don't think. It's kind of a go-nowhere stock, so I don't really look at it as shortable. I think the other thing with Tesla is it has a huge short interest right now, 22.3 days, so that's somewhere around, oh boy, let's see, trades 1.3 million, so figure that one out, somewhere around 24, 25 million shares on a 48 million share float. No thanks, I'll pass. But I think the car stinks, and the company that makes it stinks even more, and the government that owns the company that makes the car stinks even more. So, would you consider adding to SQQQ here? I don't know. Where do you own it to begin with? You know, so I don't really think that's a question we can answer. Can you answer that question, Dr. K?
So what was the question on SQQQ?
Would you consider adding to SQQQ here?
It all depends on your risk tolerance and your pyramiding strategies. I mean, that's independent. It's up to each investor to figure those things out. You know, you always need to know your exit point and what you can afford to lose in terms of your account's drawdown. So, you know, if you don't feel you have enough of it here, and then you could always pyramid additional and have your stops in place. You know, it's a pretty generic answer, but everyone has to find out, you know, what those parameters are given their trading personality.
Yeah, and we can't really answer that question for you. You know, like I said, you know, Dr. K's model says don't buy the UVXY here, but I'm willing to take the risk here and buy it using a specific stop. And, you know, so whether you're going to buy anything at any point really depends on what you're going to use as your stop if you're wrong on where you added that piece to the position, and how you're going to handle it from there if it does pull in. So that all depends on your own personal risk. So I don't see how there's some generic answer. Would you do this on this particular day at this particular time? Starbucks, you know, another stock that was acting well. It looks like it's rolling over. Is it building a base or has it topped? Unknown. But I'm definitely not, you know, this thing, if you look at this stock, I don't know if it held the 10-day, but it's already violated the 50-day. So, you know, it's already giving you sell signals, and that's pretty much it. So at best, it needs to build another base. In your view, and by backtesting, which of the three options, long, short individual stocks, 3x equity pairs, or UVXY XIV is the most profitable? In your opinion, is your opinion different when the markets are in deepening correction? I would have to say that if you just look at results of using ETS versus shorting stocks in the bear market, you make a lot more money shorting stocks. So that's my view. What's your view, Dr. K? Did that make any sense?
Well, based on, yeah, it's an oddly framed question, but the idea is that you can make a hell of a lot of gains through a few true signals using 3 times ETFs that are very volatile. You can do very well over a series of signals. Just like from August 2nd, in 8 weeks from the August 2nd sell signal, then there was a series of additional signals. If you were playing any of the inverse 3 times ETFs or normal 3 times ETFs, you'd have done very well in a short amount of time. But that said, of course, you know, I think it again comes down to trading personality. Some people are more comfortable using market timing with ETFs, and some people are more comfortable using stocks. I personally, I come from a stock origin, but having worked with my model for as long as I have, I'm a hybrid. I like doing both ETFs and stock.
Yeah, and I would say I mix it up too. So sometimes one works better than the other. Sometimes another one works better, and you really can't tell. I don't think there's any model that sifts out which is better, even in terms of trying to determine which might be better in any specific type of environment. Somebody's asking about Amazon. Is Amazon a short? No, it's not a short. I mean, it failed on the gap up, but I'm not sure if it's a short yet. It's still above its 50-day moving average. Could it be? Might it be a pod? I don't know. This is Amazon right now. You know, is this a pod? Maybe it is. We'll find out. But it still hasn't really broken down real hard here yet, so I'm not shorting it, and I wouldn't short it. If we thought it was a short, we would probably put it up. Here, Dr. K, here's one for you. With the lack of transparency in banking operations and hidden credit swap deals, do you think markets can trend in this environment?
Well, sure. I mean, trending occurs for a multitude of reasons, and to try to predict when and for how long a trend's going to occur is really futile. No one's been able to do that ever. And so to use the current backdrop of whatever, you know, pros or cons you want to put onto the market is also futile in terms of saying, well, the market's not going to be able to trend here, or it will be able to trend here. It's just a matter of looking at the market day to day and making your actions according to what data you're being given by the markets on a real-time basis, and using arguments like the one you're saying, you know, that therefore markets can't trend. That's a very dangerous exercise, because you could end up missing out on some fantastic trends. And I've seen this kind of talk, for instance, in October of 1998, when a lot of people were going short. There was a lot of doomsayers out there. A lot of people were down by October of 1998. And then the last quarter of 1998, from I think it was October 22nd or something, was one of the biggest open window of opportunity I've seen in years. So you have to always be nimble and maintain a flexible mind and just let the price volume action tell you what to do.
Yeah. Let's see. Dunkin' Donuts. Somebody wants to know what macro factors might affect this market. Any macro factors, but I won't really worry about that. I just watch the price volume action. QE3 could do it. Some idea that Obama's out and Mitt Romney has some wonderful plan to save the U.S. from doom, then maybe that would do it. I don't know, but that's all just speculation. I think you just watch the price volume action. You don't have to worry about what macro factors might drive a bull market. I mean, and, you know, on the surface, it's hard to find many, but that's when markets will surprise you because the market discounts the future, and sometimes what the market is discounting, you don't even really know what it is. So trying to analyze it in terms of, you know, what factors could do this or what factors could do that, the market looks out in the future and decides what those factors are before you even know it. So even trying to engage in the whole mental masturbation process of figuring out what those factors might be is not really that helpful, I don't think. Would you agree, Dr. K?
Yeah, it's a treacherous exercise, and I think it's something that we all get into the trap of doing because it's so tempting to do because we all want to figure out the answers for ourselves. But that's where being a little bit too smart for your own good can cost a lot of money.
Yeah. Okay, Dunkin' Donuts is just in a base. I don't really see anything here. Somebody's talking about is in a nice uptrend. I guess this one kind of depends on your time frame. You know, if you're looking at it this way, it kind of looks like it's in a nice downtrend with a bounce. So I don't really see this as viable. I'm not even interested in it. But that's what is that? You had natural gas. I mean, I don't know. Trying to come off the lows. You know, gold was trying to come off the lows last week. So I don't have much to say about that. Do you, Dr. K?
It looks like the housing stocks. You know, people trying to catch the housing stocks off the bottom. It's treacherous. I don't like playing patterns like this. I like to see, you know, I go for the daylight where, you know, you got stocks close to or hitting new highs on excellent fundamentals, and same with these types of ETFs where, you know, you have a focused ETF. I'm not going to play gold or silver until I see some kind of concerted action that, you know, we always see that in gold over the last 12 years. When gold is ready to go, you see it in the charts. It's actually quite simple to pick it off.
Right, and right now there's nothing really in NR, UNG rather. Here's one for you, Dr. K. Listen to this carefully. Comparing the U.S. and Europe/emerging market fundamentals, is it better to short the Europe emerging market this year, i.e., better returns? Question mark.
Yes, I would say that would be true so far, simply because there's so much trouble in Europe. UK's in a recession. Europe's not far behind. And emerging global markets tend to get hurt the worst when there's weakness in the more developed countries. So I am a big fan of EDZ, which is the 3 times inverse global emerging markets ETF.
Yeah, and you can see this adds emerging markets.
And as you can see, it's done quite well.
Going bonkers. So, Dr. K, since the market is a little slow, let's hear about CAN. Yeah, sure, okay.
Well, CAN has not been slow.
I don't need to hear anymore. I'm not there, and I don't want to hear about it.
I think they need to improve their internet infrastructure out here, because it's shocking that Asian countries and also Eastern European countries have had gigabit bandwidth for years now, and you know, these major countries can't get their act together, and that's U.S. included. I mean, there's just, you know, if you want to pay the price, you can get great bandwidth, but you know, your average bandwidth speed in South Korea is 16 megabit per second, which is 3 times the average of the speed in the United States. So the Asian countries are winning out completely in the bandwidth war.
I'm running at about 22 megs. So and I'm in the.
Well, you can always buy the megs if you want. But I'm saying the average person cannot you know, doesn't want to lay out a lot of money in these other countries. Well, Eastern Europe,
But
Estonia, I
that's
was
just
getting
with
gigabit
standard.
speeds in
That's with standard
2003.
cable internet. So it's not. I'm not buying any megs. So it's coming in pretty fast. I guess that makes me above average then.
You're well above average. The average person in the U.S. is getting about 5, and also if they claim 16 or whatever, it's not. It's not a real 16. The actual speed's about 1/3 that of a lot of these Asian countries. But Estonia, I believe, dominates
Continue to
because they've
rely
been
on.
doing gigabit speeds since 2003.
Okay, let's go to some stocks here. Align, ALGN. What do you want to know? Align question mark. Yes, buy it. I don't know. You had a gap up here and it's not holding. So thinner stock. I don't know. It doesn't really thrill me. Medical supplies. Earnings are okay. I don't know. It's holding in a base right now, so that's all I have to say other than that. Is LinkedIn too obvious to short here at 96.44? Would you wait for it to move back up before shorting? Well, whenever you're shorting, you want to always short it at a higher price, at the highest price you can. So, we put it out a couple days ago when it was trading up above 100, so it was sitting there and ready to go. So, I don't know. If you short it here, whether it's too late or not really depends on whether it just goes straight down or whether it turns back for a little bit first. So you kind of have to work with that possibility. I can't tell you whether it's too obvious to short here or whether you can get away with shorting here and you won't have a loss or be underwater temporarily if it tries to turn around. So obviously this rally was optimal in hindsight. I mean, this could have been your optimal short sale day here if it had just broken down. So here you're starting to roll over. Volume is higher than yesterday so far at the current rate, and it looks like it wants to go lower. So, you could short it here and use a stop at the high of the day, which I guess is 101.72 on the intraday range. So that puts you up about 5%, 4% from here, if you can stomach that. So, but I can't tell you that this is where you can short and it's either going to go down or it's going to rally first. Optimally, you'd love to short into a rally. That's why you have to be opportunistic. And you can't just sit there and then wonder what you should have done later or whether coming in late is too obvious or not obvious enough or whatever you have your head thinking about it. The bottom line is if you have the entry point near the 50-day, there it is. That's where you have to hit. If you're late, then you got to wait and see what you want to do based on your own risk preference and what you're willing to sit through if the stock moves against you if you shorted in here. So I can tell you this much, being short from up here and coming after it again this morning on the gap, I don't have a problem adding a little bit to my original position taken up here, but if it starts to turn back against me, say on the 65-day exponential at 99.95, then that portion I might cover. So, that's just kind of how I might work it. Okay, hope that helps. Can you consider giving an intraday mini webinar on how you day trade the UVXY? I'd basically throw darts at it, or I flip a coin. If the coin comes up heads, I buy it, and I use the next available stop, and that's pretty much how it works. If I get a sense the market's going to start to roll over, then I'll definitely buy it. But usually it has these sharp pullbacks. FK and I were discussing this when we were in Las Vegas last week. It'll have these moves up, and it looks like it's going to have a sharp pullback. So when you have this move up using this sharp pullback to trade it, and I sold it out yesterday. Actually, I bought it in here off the 50-day and bought it, and then sold it yesterday. Not too far off the peak. Now it's coming in. I'm not sure if I want to buy it back, but there's no technique or really any trick other than kind of feeling where it is in terms of its normal range as it gets going, and you can see that it tends to have these very sharp moves. Even if we go back, well, we're going to have to look at the VIX here, I think. If you have anything to say about this stock today, let me know. But you can see. Even when you have these big moves, it starts getting going and it comes back in. It gets going, it comes back in. So for all you know, you're in this zone right here and you're about to get some kind of move like that. Who knows? But it's not. I don't really have a specific system outside of just using normal bands of volatility that it seems to trade within. And when it comes down, try to pick it off the lows. And then sell it as it goes out. But I'm guessing if this market really starts to come off over the next few days, you're going to see this thing jump to the upside in a big way. But I don't know if I could do a mini webinar. It'd probably be like a 50-second webinar. Can you talk about strategy if you were actively trading Apple for cash flow? Well, I've been messing around with Apple long and short, and there's some obvious places. Once it violates the 10-day, you get a nice move down here. You can short any of these little rallies on a short-term basis, and I did short Apple here as it broke down through the 65-day exponential, and then I came back in here. I get long the thing and traded up to the 65-day, but that's tricks. It's kind of trying to fill your way through the stock based on what the market's doing as well, because if the market starts moving in one direction or the other, Apple's probably going to move with it. And what I did the other day, though, was once it got above this low here, you undercut, so it's kind of a shakeout. And if you're going to do a shakeout plus, X number of points for a buy point, you probably need to add 30. So I'm thinking 585 up to 595 might be, the actual shakeout plus 30 points you probably would be using. But in this case, an easier way to do it with a stock that's $567 or $568 today. Once it undercuts the 555 low, when it starts to get above it, I'll just buy it there and use the 555 low, maybe 1 or 2% max as a downside stop, because then the idea is it can continue going. Then as it comes up, I decide if I'm going to trade it. But there's just a kind of pulling it out of my rear end kind of day trading. So there's no real heavy-duty technique here other than just trying to find reference points and then trying to time my movements into and out of the stock, both long and short, with what the general market is doing. So it's a lot of it's just feel. There's no real technique involved, really. So it's kind of nebulous. Uh-oh. How come Dr. K gets to travel to the world and Gillis stay home to man the fort? If I were to go with them, I would, but I kind of like hanging out on the beach here in Playa del Rey. So it's just,
Actually, I like home base in London. I like home base, which is many places of the world. As long as I get my broadband, then I'm okay. But I don't really like having broadband issues. And generally, there's not that issue. But this time there is. So it's been a bit of a doing my head in kind of trip. But it's all right. It's all right.
Okay, someone says, I'm learning the short side. If you shorted a stock like CF at the right point, it runs down as it did. Do you add to your short position down like you might on the long side, or is it simply a risk tolerance issue? It's really an issue. Let's say if you did short CF, so let's say you shorted it right here. I actually did short this one, and I covered it the 200-day moving average. And, of course, it goes down further. And then this morning I shorted it again as it was pushing up through here, and it's coming down here, and I just scalped a few points of it because the ones I'm really going after here are LinkedIn and Salesforce. But that's basically how you would handle it. You're looking for price objectives or price targets, and a lot of times, like say with VRX, it comes down to the 200-day, so you could have shorted this one on this rally back up into the 50-day, and then you cover right here. So a lot of times you're looking for places to cover and take profits. It's not the same thing as going on the long side and trying to average up and build a position. But you should read the book that I wrote with Bill O'Neill, How to Make Money Selling Stocks Short. Dr. K and I are actually finishing up our current book, which I think is, what is the name of it, Dr. K? Ride in the Cockpits, or In the Cockpits with the O'Neill Disciples, or something like that.
In the trading cockpit with the O'Neill Disciples.
Yeah, okay. And then the next book is going to be a book on short selling, and so we'll get into that. But in the meantime, if you want to understand how to short sell, you should be reading that book that I wrote with Bill O'Neill. And that could give you or will give you the scoop on how we short. But it's definitely not the same thing. Let's see. What is this one? RST, Ross Stores. A nice flag, but it's holding up. That's about all I can tell you. I'm not going to buy it. The market's getting weaker, so I'm not really. I like being short. What I'm short right now, LinkedIn CRM, it's working pretty well. Let's see if we got any more questions. Looking through the list. Somebody says long FB, short LinkedIn. How about if I could, I'd be short FB too. I predict it's going to $22 a share. I think that's pretty much all the questions that we have today, and I hope that helps everybody figure out the market right now. But just to reiterate or review what we talked about, I think on the basis of short selling individual stocks, that can work, and I don't think you really have to worry too much about what the market does as long as you stick to your upside stops. The market direction model is on a sell, but we'd even have to say for us, even in our high octane accounts, we're still soft pedaling it. We're not coming in full bore, and you can look at it in hindsight and say, oh, I should have done that, but you're dealing with decision making in real time based on what the context of the market is and the price volume action. And so we know there's potential for sharp overnight movements. That's one of the reasons why, for the most part, I haven't carried heavy short positions overnight. I'll cover them and then try to get back in the next day. And for the most part, they do cooperate. And so I can work it that way. If I get a nice cushion in a short sale position, then I might hang with a moderate position. But, I'll try and come in 200 to 400% short during the day overall, and then back it down to maybe 40, 50, 60% overnight, and I don't, or even just go to cash, and so it's very tricky, and that's kind of how I've approached it on the short side, because I am deathly afraid. Well, not deathly afraid. I'm just accounting for the possibility of the fact that you might have some hairy gap up, with some announcement that, oh yeah, Greece is doing this, but we're going to print, and then I would be getting hammered. So I think if you're going to play on the short side, you want to be nimble, you want to be willing to trade quickly. Otherwise, I think you're okay just sitting in cash waiting for the next bull trend to develop. Or let's say if we go sideways for a period of time here, after hitting some sort of near-term bottom, that would be the first break off the peak in the general market. So if we're looking at this in terms, this would be your first breakdown, and then you might go sideways for a period of time after you hit the 200-day. Then the next leg down would probably be a much more profitable leg than this one, and that would probably be a good spot to be coming back in, short ETFs or shorting stocks again. But I think that's pretty much where I'm at right now in terms of handling the risk that I think is inherent in this market. I mean, even intraday, you could have some announcement that sends things going the opposite direction very quickly, and I think that's why if you are going to be shorting this market, you definitely have to be able to watch and monitor what's going on. For the most part, if you have a day job, not something I really want to be trying to do. Okay, I want to be watching the market and watching my shorts closely. So, anyways, that's all we got for today, you guys. Thanks for showing up, and we'll just see where this goes. For now, we could test that 200-day moving average and then see where we go from there. Anything else to add, Dr. K?
No, I think that wraps it up.
All right, everybody. Thanks for coming. We'll catch you next time. Take care.